G'day. I wanted to look at a case study from a client meeting today which looks at kicking off a superannuation pension between the ages of 55 and 60. So between those ages, any superannuation pension that you draw down, which you're allowed to once you meet a preservation age while you're working, it's called a transition to retirement pension, and you need to take at least 4% of the value out and no more than 10%. So between the ages of 55 and 60 you can still do that, but quite often we wait till people turn 60, and that means that any pension they take out can be completely tax-free. But the figures that we worked on with a fund value around $1.2 million. So you've got to take out 4% of the fund over the year. So $48,000. Now the issue is some of this money can come from tax sources. So when you've put money in and claimed a tax deduction, that will form part of the taxable component, and any money that you've put in and from a non-concessional contribution, that forms part of the tax-free. So say that is 50% taxable, where you've claimed a tax advantage, and 50% non-concessional, where you've just put in money, can be put in farming land and it's just been placed into the superannuation fund. That forms part of the tax-free. So between 55 and 60 of those ages, that means that $24,000 will be included to taxable income. That will come with a 15% tax rebate, so that means that we'll call that, say, around a $4,000 rebate, just to be really rough. So it's a 15% tax rebate. So that's included to your taxable income. So what your marginal tax rate is really important to consider whether you kick off one of these pensions. And the other 24 will be tax-free. Now the other element, and why it's really important to kick off a pension if it's worthwhile to do so, that the figures here, if you're getting on 1.2 the income you receive within the pension, and let's say it's $40,000 per year in income, so we're not talking about the growth, just the income from the fund. So yeah, 3 and a bit percent. Normally that would be taxed at 15%. So this happens within the fund itself. So based on that, that would be $6,000 of tax payable that the superannuation would fund in. You'd pay that tax internally. Once you roll to a pension, no longer is this 40 grand taxed at 15%. It will be taxed at a very attractive 0%. Now, probably one of the issues and one of the reasons why we're looking at this is we worry about what may happen with the budget that's coming up. We know that the government's looking for more ways to tax potentially higher net worth people on higher incomes. So people that are getting this very comfortable tax-free ride may be in their sights. We don't know yet, but there's obviously speculation that this could be an area where that they're looking at. So these are some of the things we're looking at. It was an interesting case study. It's not cut and dry, but there's a $6 grand saving here, and you'd need to work out what the tax is on $24,000, and that depends on the client's marginal tax rate, and then apply the 15% tax rebate to work out whether the strategy is worthwhile or not. So hope you enjoy that. If you liked the video and got something out of it, please give us a thumbs up, and please go to our website. There's a huge amount of resources there of education based, a lot of presentations and other videos, and below in the description there's a number of other resources that you can subscribe to and get some free documents to check out about home loans and also self-managed superannuation funds. Thanks for listening. I'll see you next week.